Welcome everyone, and thank you for clicking on this primer video about buying profitable internet businesses. We put this primer together to help potential buyers understand a bit more about the buying process, how these businesses are valued, and the benefits of owning an internet business. So let's dive right in. My name is Laurent Truc, and I'm the founder of MadX Capital. We are a business brokerage that helps individuals buy and sell internet businesses for profit. So think of us like real estate agents for internet assets. Even though we do buy and sell businesses for our customers, we do focus mostly on the buyer side as buyer brokers. A little bit of background about me. I worked in corporate my entire life, mostly in sales and sales management, and most of what I did was negotiating contracts. About 4 years ago, I started buying, operating, and selling online businesses on the side to mostly diversify my investments. And I really fell in love with the space. I realized, however, that this industry was very one sided in favor of the seller. Unlike real estate, where you have buyer brokers and seller brokers, and they each have fiduciary responsibility to their clients, in this space, we have intermediaries. We don't really have brokers. And so, even though they're supposed to represent both sides and help the deal, help facilitate the deal, the reality is they're paid by the sellers, they have a contract with the seller, and they're really motivated to sell the business at the highest price possible. So, luckily, I had been negotiating deals my entire career. So I knew the game. I knew what to look for to make sure that I got the right value for my assets and that I didn't get ripped off or scammed. But I don't believe that's necessarily the case for everybody. Most buyers will buy one, two, maybe three internet businesses in their lifetime. And so they really don't have the experience and know what to look for. So I thought there was a very clear opportunity to have a buyer broker in this space, really representing the buyer to help them with due diligence, identifying the value of an asset, and spotting a good deal and negotiating on their behalf, helping close, and being somebody in their corner. And this is how MadX really started. And just to finish off the intro, so I'm a business broker. I'm also an investor, and I've operated a number of different online businesses over the years. Authored a book, Become an Internet Business Mogul, which talks a little bit more about the financial side of investing in online businesses. I'm the fund manager for Sleeping Beauty Funds, where we invest in online businesses, both from consulting perspective and a financial support perspective. I have a podcast called the Mad Profit Podcast, and I'm also the Toronto chapter leader for Internet Masterminds. So I'm heavily involved in the field. I've been in the field for quite some time now, and it really is a passion of mine. And I love nothing more than working with clients and trying to find the right business for them. So, a brief agenda for today. We're going to talk a little bit about why buying a business is important. So, a little bit about the benefits of business ownership, why buy and not build. We'll talk a little bit about acquiring online businesses. So, the different types of monetization that exists out there. How do you value an online business? How do you source the right deals? Where to look for deals? And I'll go over the purchasing process as well. And then finally, I'll talk about what I view are some of the keys to success. Having been doing this for some time, there are definitely different things that you can do to put yourself in a position of gaining higher returns and reducing your risk. So I'll talk a little bit more about that towards the end of the presentation. So the benefits of business ownership. It doesn't matter really the reason that you're buying a business. Some people are buying businesses, online businesses, as a side hustle, or because eventually they want to leave their job, so they're looking for something that they can build, and then they can do full time later. There's also a big push around the nomadic lifestyle of being able to live anywhere in the world, and having an online business gives you the ability to really be anywhere as long as you have an internet access to run these businesses. But there's also a lot of other benefits to business ownership, and not just online businesses, but businesses in general. So, for example, higher returns. If you're looking at investing in online businesses just from a pure return perspective, you're definitely going to be making more money than leaving it in your bank account nowadays with 0 to 2% interest rates around the world and negative interest rates in some places. But even better than you're going to get in the market in many cases. I mean, you have to look for those deals, but it is not uncommon to get 25 to 40% plus return on investments on some of these businesses. And I think once we get into the valuation piece, you'll understand a bit why that's so. But higher returns is definitely one of the reasons for business ownerships. And then creating levels of diversification. So if you already have a portfolio, like many people do, a 401k plan, you're into stocks, bonds, mutual funds, things like that. This owning a business is a great additional asset to have to diversify that portfolio, especially a smaller local business or an online business, which isn't as global or manipulated by global forces as your stock market is. It's also a great diversification play if maybe you're into real estate. So a lot of my clients have already an established portfolio and are looking at internet businesses for that new level of diversification. You also get a ton of leverage. You're able to leverage systems you put in place, your employees that you put in place, processes, and with leverage comes the opportunity of making more money. You have more direct control. It's your business. You get to see opportunities. You get to change the direction of your business, create new monetization methods, whatever you need to do. That is in your control to be able to move your business and react to the environment, which is not the case when you're part of a larger business as an employee or whether you're investing in the stock market. And I think everybody knows this. Business ownership also provides better tax benefits. Again, talk to your tax accountant to get more information on that. But whether internet businesses or brick and mortar, there are opportunities that are much more exciting as a business than as an employee from a tax perspective. And it's also a tool to manage inflation. You can increase your prices as a business depending on how inflation works, which is not necessarily the case with your salary. You're not always getting a bonus or an increase to your salary when inflation goes up. And there's also a great number of benefits for an online business specifically. So on top of all those benefits, you're location independent. Like I said, you can be anywhere around the world as long as you have internet access. You have less overhead. There's no lease. There's no commuting costs. You don't need full-time employees. They're mostly contractors. You also have a global reach, both of customers and of talent, labor pool. If you look at that top right quote there, global labor pool, you can get talent all over the world and at better prices than maybe you can get in your backyard. It's easier to diversify an online business. You can add more monetization methods. You could go after different types of customers at a much easier pace than if you're a brick and mortar. You're also open 24/7, 365. So you're making money while you sleep. The engine, the process, the systems you have in place continue to work whether you're involved or not involved. And you can install as many automated solutions. And when I say automated, it could be both technology or it could be human capital through virtual assistants and different types of global employees that could streamline your business and really work for you. And then you create a schedule and work flexibility. At the end of the day, it's your business. You decide when you want to work. Some businesses are heavier than others in terms of man hours required. But there is an expectation of a certain response rate, but at the same time, it's your business. You can kind of create the hours that you need to do. So there's a lot of these types of benefits in owning a business. And what I love about just online businesses in general is the unbelievable rapid growth. You can see a couple of charts that are all going in the same direction here around how e-commerce is moving, how many more people are buying online versus retailers. We're seeing retailers close left, right, and center these days. And honestly, with COVID, it's only accelerated that even more. And I don't think when the new norm takes place that people are going to stop buying online. It's just the convenience of it, the options that are there, and now with delivery charges, Amazon's created such an amazing system that you're getting your products within 2 to 3 days. Why not? Why not? So I do get this question a lot. So I like to bring it up: is why buy a business when I can just build one? And it's absolutely true that nowadays the barrier to entry of starting a business is very low. You can create a website tomorrow for next to nothing. A domain is a couple of dollars a month. Hosting is maybe $20 or $30 a month. Then you can have a blog up and running. You can put some affiliate revenue. It does not take a lot of cost. What it does take is a lot of time and a lot of risk. So, 50% of new businesses fail within the first 5 years. And when you examine the long run, there's pretty similar costs in buying a business versus starting a business. When you're starting a business, there's a lot of trial and error. You're tweaking different things. You're trying different products. You're trying to get a brand out there. You're trying to market yourself. You're spending money little by little, not lump sum like you do when you're buying a business. However, you are definitely spending the money. On the other side, you're spending a lot of time, and there's also no guarantee that the time you're putting in is going to turn into a return. As a test, I started a blog back in 2017 to see how long it actually would take for Google to notice, and I was publishing a couple of articles a day, and it took 9 months before I really started getting any sort of traction. So that's just traction. That's just people coming and actually viewing the site, let alone monetizing and tweaking and building automation. It was just a ton of time. So the benefit of buying a business versus starting a business is, one, you get to choose from the 50% of the businesses that have not failed. So you get to look at businesses that are successful and that have validated the product, that have already educated a market on what they do. There's probably some brand recognition out there. They've optimized their marketing. Their processes are streamlined. I mean, they're making money, so you see that whatever they put in place is working. They've hired the right people, or they've outsourced the right people, or they've implemented the right technology implementation that they need to run their business. And they validated that the business is profitable. And so when you buy a business, really all the hard work's been done for you. You get to go to the front of the line, and you get to only look at the businesses that are producing what you want them to be producing. And on top of that, you get historical information about how those businesses have done over the years. It allows you to make a better decision on your purchase. So there's a lot of benefits. And my personal benefit of buying a business is the transition. You're actually getting the insight and wisdom of the seller when you buy a business. I usually do 2, 3, 4 month transition times with sellers, and I set that expectation up front because I want to learn as much as possible about the site, about the business, about the vendors, about the industry, about the customers. And you have essentially a free consultant that is there working with you to make sure the business continues to produce as it's been producing for them. If you're interested in learning more about my views on buying versus building, you can go to madxcapital.com. On the front page, a little lower, there's this ebook by Don't Build that's free to download. So let's talk a little bit about the types of online businesses that exist, the types of monetization that are out there. So the first one is affiliate marketing. So essentially, affiliate marketing is you are representing somebody else's product and you're trying to sell it on their behalf and passing on the lead. So it could be anything from like a blog where you're talking about a specific product and the benefits of it, to a YouTube video, to an email campaign. Affiliate marketing comes in a lot of shapes and sizes. There's lead generation, similar. So right now, the hot fields for lead generation are university programs, nursing programs, things like that. So essentially, it's a lead capture site which talks about different aspects of maybe a career choice, and then if you're interested, you fill out a form. That form actually goes to a bunch of universities, and they pay for the leads that the site submits. The next one is advertising. So advertising is probably the oldest form of monetization on the web. When the web first started, people were buying banner ads. Banner ads are still around, but they've evolved, and now ads are being posted through really complicated ad networks. There's bidding for prices in fractions of a second. The ads are based on user cookies, so it's gotten much, much more complicated and much more tailored to improve the user experience and improve the click-through rate and close rates. Digital downloads, which is one of my favorites. It's really ebooks or training courses, some sort of a product that is digitally downloaded. These are great because you don't have to hold any inventory. As digital products, you build them once and you can sell them over and over again. Content and blogs, these are monetized in a bunch of different ways. Usually it's some form of one of the things we talked about so far, advertising, affiliate marketing, digital downloads, things like that. Subscription, so whether it's subscribing to a newsletter to give you stock tips, or whether it's a subscription box of certain products that are sent. Subscriptions are great because from a buyer or an owner perspective, you're getting a recurring revenue stream every single month or every single quarter, depending on how you have it set. So these are really valuable type of assets that sell at a premium. Software as a service also sells as a premium. Essentially, this is any sort of software that you log into, your accounting software, things like that, for example. And again, they're usually paid on a monthly basis. These are also a little bit more expensive because there's a lot of programming that's involved to establish the software in the first place. And it really does have a nice recurring revenue stream, which people look for. E-commerce, which I think everybody knows, the hot platform right now is Shopify. Amazon FBA kind of falls under e-commerce, except it's kind of done for you. We'll get into that in a little bit. Drop shipping, which is e-commerce where you don't actually need to hold any product. The manufacturer directly ships the order to the customer. So all you're taking is the order up front, and you pass that order over to the manufacturer and they take care of everything. And then really the most popular is multiple. There are very few sites that are only monetized through one system. Most of them will have multiple monetization methods. So how do we determine the value of these businesses? So in, for large corporations, some people will talk about EBITDA. For smaller businesses, they'll talk about cash flow. In general, we talk about seller discretionary earnings. And this is really profit. So if you take what the business brings in revenue minus the expenses, whatever is left is seller discretionary earnings. Why it's not called profit is because there's different ways that a owner of a business can use those funds. So in some cases, they may get a lease under the company car. They may be expensing their vacations, whatever it is. So that really should not have an impact on the value of the business. So we lump it all into discretionary earnings. So an online business has a certain amount of discretionary earning. Let's call it profit just to make it easier. And then there's a multiple that gets attached to it. And the multiple is really based on the type of business that it is. So for example, a drop shipping business, which has a very low barrier to entry. I mean, all you got to do is put up a website, talk to a manufacturer. You never have to hold or pay for any product up front. Those will tend to go at a lower multiple. If it's a SaaS business, those will tend to go at a higher multiple because there's upfront software that has to be done. It's a recurring revenue stream. And when I say multiple, essentially it's just that. It's a multiplying factor that we are using to create a fair value for the business. So let's say your business makes $100,000 in profit per year. If it's a drop shipping site, it would probably sell for 1.6 times that. If it's a SaaS, it's probably going to sell for a four times that, right? So $400,000, and that's how we come up with valuation. Now, the reality is it's a little more complex. If you look here, we also add or subtract based on different variables. So a business that has been in business for a longer period of time and has sustained growth for 3 or 4 years will have more value than a business that's only been around for 6 months. So we may mark up the multiple a bit more for a business that's been properly aged. If the business has strong diversification, so it's got a number of different types of platform that it's on. One of the first sites that I bought was an Amazon FBA site, but it also sold on Shopify, eBay, Walmart, and had a bunch of other revenue streams with it. So that was a well-diversified business, which lowers the risk if one of those platforms decides to change their policies and it causes an issue to our cash flow. We have four other sites or four other components that continue to make money for us. So we would be willing to pay a premium for those types of businesses. Other things that may impact is automation, right? The more automation that's there and the less the owner has to actually do on the site, the more value it has. Growth potential, depending on the niche that it's in. If it's a saturated niche, we may penalize it, so to speak, on the multiple. How the traffic has been trending is huge. If it's been kind of flat or declining, we're definitely not going to pay a premium for it. But if it's been on a rapid growth, we're going to expect the growth to continue. And therefore, we would be willing to pay for more. There's potentially additional assets like a big email list or a huge social media following, or maybe even recent news articles that have created a huge hype around the business. So even though the formula is relatively straightforward, seller discretionary earnings times some sort of a multiple is the market value. There's a lot of nuances that also come into the equation when we finalize what the value is really worth or what the business is really worth. So here's a really quick example. Again, same equation, seller discretionary earnings times a multiple plus or minus based on the variables is your market value. So if you have revenues of $10,000 a month, your cost of goods, let's say this is an e-commerce site, your cost of goods might be $3,000, and then you also have expenses. So you subtract all that from the 10,000, you're left with $5,000 a month as a seller discretionary earnings, or $60,000 a year. As an e-commerce business, they sell for about a 3x multiple. So it would be valued as a $180,000 business. Then we start looking, that's our starting point. Then we start looking, okay, how old is it? Is it well diversified? Is there automation and all that? And we reduce or increase that 180 based on that. So I get a lot of questions around where do we source deals? How do we find good deals out there to buy? And this is where a buyer broker becomes extremely handy and helpful. There's really two places to buy deals. There's on-market deals and off-market deals. On-market deals are deals where the business is already out there being sold. So there's usually a broker involved. The seller already has in their head, I want to sell this business. They're probably advertising it on a lot of the different exchanges that are out there. And when that happens, more people know about it, the more the demand is there. There's a bit of fighting for the asset. So they're typically more expensive. It's harder to negotiate good terms. There's a lot more competition of people trying to buy it. The seller is better prepared. So that's definitely a benefit of on-market deals because they work with a broker. Brokers will have templates, so their P&L, their profit and loss statements will be well established. They will have had all their ducks in a row in terms of transferring the assets and putting operational procedures in place. So that is a benefit of buying on-market deals. It's also a little harder to lock them into a letter of intent. So when you're about to buy a business, especially a business over $100,000, it's usually a good idea to put a letter of intent together that says, hey, I'm going to buy your business. Here are the terms. If we agree to these terms, please take it off the market so that I can do some due diligence before I close the business. If it's on market, they'll probably have a bunch of other competing offers, and so they're highly unlikely going to take the deal off the market. They'll say, do your due diligence, but it's first come, first serve. So you need to be a lot quicker to decide. You're not going to get great terms. Most sellers are going to want as much money up front as possible. And your broker can actually, having a broker can help reduce some of the risk, right? You can ask some questions to a broker and get a little bit more clarity than if you're off market and working with somebody who may not be as much on the up and up. So off-market deals are kind of the opposite. It's somebody who either hasn't even thought of selling their business, right? So they're just running a website, and people know there's a marketplace out there now for businesses, but they're probably happy with what they're doing and haven't really thought that, hey, this is a good time to sell. Or they're trying to sell it on their own and they haven't really put it on many exchanges. They may have told a couple of friends, and so they're kind of half committed. They're not fully committed. So the benefit there is you can usually get them at a bit of a less expensive rate. They don't have a broker whispering in their ear saying, "Hey, you should be getting at least X for your site." You can come in and say, okay, this is what I'm seeing. Here are a couple of comparables. Here's what I think is fair market value and what I'm willing to pay for it. So it's easier to negotiate. There's definitely a lot less competition because nobody else knows that the business is up for sale. But the seller is usually very unprepared. They don't necessarily have a profit and loss. They probably don't have their operational procedures all documented. Imagine you're kind of taking them by surprise. And so you're going to have to work with that seller to be able to put all that together, so that you get a very clear picture of what the business looks like and therefore what the business is worth. It is easier to put them in a letter of intent. I mean, you send them a letter of intent and you say, hey, what we ask is that you do not advertise that you're selling this business until either we buy it, or if we decide not to buy it, then you can do that after that. You can take your time to negotiate. There's not a lot of competition, so you can really be thorough. And you can get seller financing. So seller financing is really big in this space. There's not a lot of conventional, but there is more and more conventional financing that's starting to creep up, but that's only recently. So seller financing historically has been the only way to get loans to buy these businesses. So seller financing is simply telling the seller, hey, I'm not going to pay 100% upfront. I'm going to pay a certain portion upfront, and then the rest I will pay over time. So the seller is essentially giving you a loan for the balance of what is due on the business. And there is a higher risk. A lot of the brokers out there will do a certain level of due diligence because their brand is at stake. So if there is no broker, then you're kind of trying to put all the different pieces of the puzzle together to decide whether this is a legitimate business. And that's where a buyer broker can help, is understanding where to look to make sure that they own the domain, to make sure the site wasn't some other type of site before that and maybe got penalized by Google. I mean, there's a lot of things in due diligence that's required in order to make sure that you don't get scammed. If you're looking for on-market deals, there's a lot of places to go. The big one, so on the left are the exchanges. Exchanges are essentially where you can put your business up for sale, and it's a list of all businesses for sale. It's kind of like realtor.com or something like that. So Flippa is the really big one. They've been around for a very long time. BizBuySell is not uniquely for online businesses, but they do have quite a bit of online businesses there. The exchange is for Shopify sites only. BizQuest and Business for Sale are also just large business exchanges, and they do periodically have some online businesses there. On the right-hand side, these are the brokers. So there's a few really big, well-known brokers. Empire Flippers is by far the 800-pound gorilla in the space. FE International at the bottom there is also up there in terms of size. And then Acquisition Station is a bit smaller, Latona's is a bit smaller. And then you have just general business brokers that will sell any business. And sometimes they do come across online businesses. So Sunbelt is the biggest business broker in the world. They don't have a lot of online businesses, but once in a while they do. If you're looking for online and brick and mortar, which is a pretty good combination, I think you're going to see more and more of those as companies have struggled through COVID, have been forced to find ways of monetizing their business online. Sunbelt might actually be a good option. But again, just as a warning, these are all seller brokers. They call themselves intermediaries, but their focus is helping the seller sell the business. And so, going through any of these routes, you are going to face competition. Recommendation is that you be prepared if you go through this route to jump quite quickly at an opportunity if you see it, because they tend to sell. They tend to sell very quickly. So here's a purchasing process, and I'll try to go through this relatively quickly. So first, you're probably going to need to sign an NDA. So if you go on one of these exchanges, you'll get a very small blurb about the business, a little bit of history, a little bit about top line revenue and profit, and they're not going to give you that much. You then say, hey, I'm interested in the business. They'll send you a non-disclosure agreement. And non-disclosures are important because in some cases, these businesses may have employees and the employee doesn't know that the business is for sale. So the non-disclosure agreement is that you're not going to compete with the business. You're not going to tell anybody that the business is for sale. You're not going to steal any information that you learn from the broker, the seller, and the prospectus. So don't feel offended if a broker asks you to sign an NDA. It's just part of the process. And as a buyer broker, I'll usually do that for my clients so that my client doesn't have to sign a bunch of NDAs every time. Then we get the official prospectus. So this is usually a 1 to 5, sometimes 10-page document that it's kind of the selling version, the sales version of the business. So it will review the business at a high level, some of the history, why it was built, some of the information about the owner. It'll go into some detailed profit and loss. It'll talk about the growth. It'll talk about some opportunities and strategies they recommend. And it really itemizes all the good and positive things about the business from a sales perspective. And it's a great way to learn about the business, learn also a little bit about the industry, understand why the seller is looking to sell. It'll give you some indication whether the seller is a motivated seller or not. Once you do that, then you start having some calls with the broker and the seller. So typically the broker will be your first line. He'll vet out people that he doesn't believe can afford it or really are just tire kickers and not really interested in buying. After that, you'll get into a seller call. Seller calls, you'll talk about the business, ask any questions that you want. Typically, you'll have, depending on the size of the business and the investment, one seller call if it's very small, but 2 or 3 or more is not uncommon as you get into larger types of businesses. If those seller calls go well, then you sign a letter of intent, which essentially is the basis of the agreement. Here is what I'm willing to pay. Here are the terms by which I want the business. And typically in a letter of intent, which is non-binding, by the way, you'll ask for the business to be removed from online, which typically doesn't happen. They will not remove the advertising of the business because somebody else may come in and want to buy very quickly, and then they don't want to lose out on those opportunities. If the letter of intent is accepted and everybody's in agreement with the price and the structure of the deal, then you'll go into due diligence. At that point, you ask for all the information, you review everything, the financials, make sure they have the right customer list, make sure they own the business. As buyer brokers, we have a huge checklist of things that we validate and double check. And then finally, you make the purchase. So it's a final contract that gets put together. Your money goes into escrow and the assets get transferred. You usually have a period that you define of validation. So that the standard is 7 days if you use escrow.com. And during that time, you're making sure that the money that flows into your account is what you expected, that all the assets are what you expected, and that there are no surprises. Once that's done, you release your money into escrow, and you are now the proud owner of a new internet business. So I want to talk a little bit about my view on keys to success as a buyer and operator of online businesses. So the first one is you got to review a lot of deals. If you're a buyer, if you're using a buyer broker, the benefit is the buyer broker has and is reviewing deals on a regular basis. So when I first started, this was kind of the magic formula I used. I would look at 300 deals. Most of them were not worth my time. I would then take a look at least 100 different prospectuses. So signing the NDA and getting those prospectuses and just diving in, understanding all the deals and all the pieces of the businesses. Of those, there's usually 30 that I find interesting and warrant a seller call. I'll have about 30 seller calls, and then I'll get down to 3 that I'm pretty excited about. And I'll start playing around with 3 offers. When I say offers, they're letter of intents, just to make sure that I'm getting a great deal. And then at the end of that, I'll get one high potential purchase. Not to say that that purchase will happen, but I have one high potential. What I like is to have 3 high potentials at any given time, so that I can really let the numbers choose which business to buy. So uh, I would say the first rule is it's a numbers game, and be prepared to look at a lot of deals if you're looking to buy on your own. Okay, the second thing is buy smart and buy right. So this is just a small list of things to be careful of when you're dealing with sellers and when you're looking to buy a business. So first, build rapport with the seller and the broker. This is not supposed to be a contentious relationship. You're going to have to be dealing with the seller for the first few months as they transition. You're going to have questions for the broker. It's a good idea to build a very strong rapport, and I've had deals where I got the deal because the seller liked me more, not because I paid more money. So it'll help. Look for a win-win. I mean, there's usually a reason the seller is selling, and it's not always to get as much money as possible. So try to understand what the seller wants, and if you can get them that, then typically you'll be able to get a good deal on your end and get a higher return on your investment. Conduct robust due diligence. Do not skimp. Make sure you know what you're buying, and watch out for scams out there. Um, Try to negotiate as little possible down. It's getting harder and harder because there's more buyers out there that are looking for online businesses, and the good online businesses tend to have a lot of competition. So the sellers aren't really in a position where they have to offer financing. But the less down that you can put, the less risk you have. Because if you're not getting what you want and the deal falls apart, it's easier to go after your smaller amount of money. And so there could be less of a loss if something doesn't go well. Look for underutilized assets. I think a lot of people don't do this enough. They look for the business and see how much the business makes, and for them, they make the decision on that. But if a business has a very large email list of customers, for example, that they've never retargeted, there's value in that. There was a business the other day that I was looking at, and they just advertised about the one domain that the main website was on. It was a blog, um, but the business owner also had 50 other domains, and he was willing to put them as part of the deal. And when I looked line by line, some of those domains were worth hundreds and thousands of dollars. So there's a lot of assets that are hidden in these deals. Sometimes there's inventory. Sometimes there's inventory that doesn't sell, and the seller has never tried to just offload them to a local brick and mortar shop. And so there's different things out there that you can look at to see more value in the business than even the seller might realize they have. Also, just have your ducks in a row. Be prepared to move quickly, especially deals under $100,000. They literally sell in a day or two. So you need to have your finances prepared. You need to be prepared to tell a seller, hey, if I give you a deal, I'm willing to close by tomorrow. That'll give you a huge leg up on a lot of other buyers out there. And last but not least, do not make an emotional purchase. I'm a big fan of not necessarily falling in love with the website, but fall in love with the returns. This is about an investment. This is about making money. If you just want a site that's about a niche that you're really going to enjoy, then maybe start the niche from scratch. But if you want to find something that's going to give you recurring income, potentially build wealth, then do not make it an emotional purchase. It's like buying a piece of real estate as a rental property. It's probably going to look a little different than your primary residence. Three is use a buyer side broker. So obviously a little selfish for me to say that, but it's important, especially if you haven't bought more than 3 sites. I would definitely recommend using somebody and having a partner in your corner. So we conduct the search for you. Like, we're going out and we're finding on market, off market deals. We're looking for undervalued assets. We are doing a lot of the heavy lifting and hard work. As importantly as we're weeding out all the poor deals. You can spend a lot of time looking at a deal that you think is good, not knowing that it's in a overly saturated industry, or that there's something wrong with the product that we may have heard of or learned about through some of our other dealings. We have access to a lot of off-market deals, which is where you get better opportunities. And having a broker on your side like us, when you do find an off-market deal, we deal with the seller to make sure the seller puts their profit and loss together, understands what the flow and how these businesses sell. We get to be in there and really assist. We're also expert negotiators on your behalf. So it allows you to have us at the table doing the hard negotiation, which makes it much easier when then you take over the business, because you and the seller still have a very friendly relationship. As a buyer broker, we always try to maintain the friendliest relationship, but sometimes it gets heated when we get down to negotiating, the smaller aspects of the business. We provide protection against scams and misrepresentation. We can ensure that you're not overpaying for an asset. We can provide growth and automation strategies. And to me, that's actually a big part of what we do, is really help you understand how the direction the business should be going in and how to focus your time on putting things in place that will increase the value of the business long term. And then we give you guidance on how to do due diligence to make sure that you're protecting yourself and your assets. My other key to success is to have laid out a 6-month success plan. A lot of people will take on the site and they'll just continue running it the way it is, and they'll try a couple of things without necessarily having a strategy in place. And a year later, the site hasn't grown. It looks exactly the same. They actually have dipped because the seller doesn't have the same experience as because the buyer didn't have the same experience as the seller may have had. So my recommendation is a plan like this, where you take possession of the asset. In the first 3 months, you're making sure you're stabilizing the business. So you're monitoring all the revenue and all the traffic. You're learning how the business works. You're documenting the standard operating procedures. You're potentially looking for different opportunities to improve the site, but you're really engaging with the seller and understanding how the site works. That's kind of those first 3 months. After that, you want to get into a rapid growth stage. So look to add different monetization methods. Look to reduce any expenses. That's probably the easiest way to improve your return on investment and increase the value of the business. Look for other vendors and partners that you can do different co-branding with, or different ways to increase your sales and brand recognition. See if you can renegotiate any contracts. Maybe if you have a drop shipper and the seller has never gone back and tried to get a discount, and they've, maybe you've become their biggest drop shipping source of revenue. So you might have an opportunity to go back and renegotiate better terms. Really what you're looking for is just monetize every part of the business that you can. And the reason that I recommend to do this as early as possible is because the value of a business is based on its revenue. And so if you're able to increase sorry, on its profit. Remember that seller discretionary earnings we talked about? So the faster that you're able to increase the seller discretionary earnings, the faster that you've increased the value of that business. And so if in 8 months, 12 months, you want to sell the business, it's already increased in value and you can make a profit. So we're looking at how to lock in profit at this point. And then in that last month 6 and 7, or at month 6, it's all about automation. How do you find ways to extract yourself from the day to day? So putting reports together, putting in software that can replace some of the manual processes that you do, finding virtual assistants or online business managers that can come in and take care of different components. Um, and really the focus, it depends how much you love the business. A lot of people see these as investments, and if you can automate, you can then extract yourself and move on to the next deal. If you're stuck doing everything yourself, then you're going to be limited with only being able to buy 1, 2, maybe 3 sites at the most. So this would be the success plan that I would recommend for my clients. And then my tip number 5 is create a successful portfolio. So you've just gone through the process, you've bought a website, you've learned a lot, and it's a great opportunity to take those experiences and that knowledge and start looking to acquire more sites. By building a diverse portfolio, especially one that's automated, so it's not taking you a lot of time, you can improve your returns and lower your risk. So imagine having a number of different websites that you own, different niches, different monetization methods, different customer bases. If something goes wrong with Google and they change their algorithm and you get less traffic to your blog, that could be a major impact. But if your one blog site is one of a number of sites, it may not be as big of an impact. And so diversification gives you a certain level of protection. Only works if you've properly automated your sites, because otherwise it becomes a lot of work. But there is a lot to be said for the reduction in risk by having a portfolio. And then what it gets really interesting in portfolio management is when you have a number of different assets, different businesses, and you can start using them across each other. So a customer list from one site that you leverage for the benefit and growth of another, or a social media account that you can market one of your programs from another site with. So it's about diversifying your portfolio, but keeping enough of overlap that you can use the customer base of one site to help grow one of your other sites. And eventually there's the opportunity of bundling assets together. So we talked about the importance of multiples and the benefit of having more than one monetization method allows you to increase your multiple. So part of a portfolio strategy is to take a number of different sites, package them together. Ideally, the sites are related. You package them together, and instead of selling each one at a 3x, you're now selling them at a 4.5 or 5x because they're much larger, they're better diversified, and they're just a lot less risky. So there's a big opportunity when creating a portfolio if you do it right. And finally, sell to maximize profit. So sell before you actually want to sell. If you're at a point where you're tired of your site, you've had it for too long, and you just want to get rid of it, you're not going to be able to sell it for maximum profit. The buyer will feel that in your voice, will see an opportunity to lowball you. You'll probably take the first offer that comes along. And if the offer doesn't close, you're going to get frustrated that you still have the site. You're not going to focus on it. And it's just going to go down in value. So sell before you really want to, and ideally sell when your site is at its peak. Also be prepared. Be prepared and organized. So have your profit and loss statement properly created, have your standard operating procedures, create a spreadsheet with all the different assets that you have, social media accounts and how to log into them, have a customer list ready, a vendor list ready, whatever you need to transfer over, have that ready. And even explain that to the potential buyer that you're all set to go, everything is packaged and ready. And the buyer will see that as an asset and will probably be willing to offer more or be more flexible on terms. You also want to time your exit to the market. So just like in any market, there are highs and lows, and sometimes one monetization method is more popular than another. Maybe Amazon FBA might be at its peak, or maybe drop shipping might be not much in demand. So supply and demand plays a big part in the value of your business. Back to that multiple we talked about. So understand what's going on with the market, understand if the timing is right, and maybe if the timing is wrong, hold on to your website for a bit more until the niche that you have or the um, monetization method that you have is more in demand. And continue to network. So make sure everybody knows that you're selling a website. The more that you're communicating out there to different social networks and different people, the more likely that you're going to find a high paying buyer. And why I say high paying buyers, that different buyers will value different businesses at different rates based on what they need, right? Let's say I have a specific business and a niche and I'm trying to get into another niche. I'm going to look for a strategic purchase. I may be willing to pay a premium over other buyers because it allows my business to grow much more quickly by getting access to this other business. So just communicate out to the world that you're looking to sell your business and really look for strategic buyers that make sense. And finally, don't be afraid to use a broker. It is expensive, but using a broker allows you to sell much more quickly, allows you to get a much broader audience, therefore, likelihood for multiple offers. Typically, a broker will pay for itself. They'll get you a higher price for the business than you would have been able to do yourself. And at the same time, you'll have a coach in your corner and somebody to help you sell your business quickly and at the maximum rate. Like anything, when you're dealing with a broker, find a broker that you can build rapport with. Don't go with the first broker, shop around, find somebody that makes sense, that has the experience that you're looking for, that you get along very well with, and that you can trust. You will be working with them for a certain amount of time. And it's a good idea to make sure that there is a strong working relationship there. Thank you, and I hope this was helpful. Our goal today was just to give you a primer and a bit of a feel for what to look for when you buy online businesses and a bit on how the process works. If you are interested in buying a business and you want some advice, you want to see if we're the right people to work with, please go to madxcapital.com. Book a free 20-minute consultation. It'll probably be with me directly, and we could talk about what your goals are, any questions that you may have about acquiring businesses, and we could take it from there. And like I said earlier in the presentation, if you want the free ebook, we do have it on our site around buy, don't build, and I'll give you a little bit more about our philosophies on the importance of buying a business versus trying to build one from scratch. Hope this was valuable. Please do not be afraid to send us an email if you have any more questions. You can actually contact me directly at Laurent, Laurent, at madxcapital.com. And I'll reply as soon as possible. Always happy to meet new people and talk to new people. So looking forward to connect. Thank you for your time and patience during this presentation, and hope we will see you soon.